So brief exercise 3-7 asks us to prepare transactions and adjusting entries for depreciation. So when I buy a long-term asset, we sometimes call it PP&E, property, plant, and equipment. So in this scenario, it is equipment. So when I buy equipment, I can use it for more than just a short-term time. Usually it's for multiple years. So what I have to do is show the use of. It doesn't last forever, so I am using that piece of equipment to generate revenue and earn profit. So in that case, I do need to depreciate or use it up over the life of that equipment. But it's not a short-term item, so it's a long-term item. So in this question, it says on July 1st, 2017, Masood Company purchases equipment for $30,000. The company uses straight-line depreciation. It estimates the equipment will have a 10-year life, and Masood has a December 31st year end. So when we're approaching these questions, we'll have to look at the dates. When did I buy the equipment? When is the year end? Okay, so in this case, I bought it on July 1st, and they have a December 31st year end. So what happens is when we hit a year end, we have to make all those adjustments to go, okay, what have I used up that I haven't yet recorded? So in this case, we'll record depreciation. But to start, Part A asks us to record the purchase of equipment. So again, when I purchase equipment, that was a little weird on my computer's part. When I purchase equipment on July 1st, 2017, I'm going to debit the equipment account. I'm going to increase my asset by $30,000. That's what I purchased it for. And again, it says I purchased equipment. It doesn't say on account, so I'm going to assume I paid cash for that account. So I'm going to credit cash for $30,000. So I have purchased equipment, or Masood Company has. So I'm going to record the increase in the asset of equipment and decrease of cash. I had to pay cash to purchase the equipment. All right. Then it says calculate the amount of depreciation they should record for the year purchased. All right, so I've got a piece of equipment that's worth $30,000. I expect to use it for 10 years. So I'm going to use up this piece of equipment over the next 10 years. So in my first year, so for 1 year, I will take $30,000 divided by 10. Okay, so each year, full year, I'm going to take $3,000 in depreciation. But in the first year, I purchased it on July 1st, and I'm recording my journal entry at year end, which is December 31st, which is 6 months. Okay, when I'm counting months, I do it on my fingers still, so if you want to too, I go July, August, September, October, November, December. That's 6 months. So essentially, I'm going to take a half year of depreciation. So I'm going to take the 3,000 divided by 2 for half a year or 6 months, which is 1,500. So on December 31st, when I'm preparing my adjusting entries, I'm going to show that I've used up half a year of the equipment. So I'm going to debit depreciation expense for $1,500, and I'm going to credit, just going to see so we can see it here, an account called accumulated depreciation equipment for $1,500. So we don't actually depreciate put depreciation into the actual equipment account. We use a contra account called accumulated depreciation. We want to show the original cost of the equipment less what we've used up. And the reason being is for the users of the financial statements. If I'm looking at the financial statements, I want to see what the piece of equipment cost and how much is left that we haven't depreciated. That tells me that we're going to have to either buy equipment soon because we've used up almost the whole piece of equipment, or that we just bought it and we're going to not have to purchase another one for a bit of time. And so accumulated depreciation is a contra account, and it sits right below. So in the financial statements, we'd have debit equipment for $30,000, or we'd have equipment showing, and then right below it, it's happily married, is accumulated depreciation for the equipment, which we'd show as minus 1,500. And so our net piece of equipment at year end, so our year end, what's left that we haven't depreciated is $28,500. So we've used up $1,500 of that equipment because we still are going to use it for another 9.5 years. So that's how we calculate and prepare depreciation, adjusting entries at period end.